Alrighty, so one of the sorts of questions we had ourselves when we were developing this entry model and when we were testing was, how do you determine if the fake break, if that strong liquidation has occurred too far away from the POI? In other words, once we actually get our POI mitigation and we're looking to take the trade, and then we look left to see if a strong liquidation has already occurred, well, if we can see that one has occurred up here and it's quite a far distance away, is that still really relevant to taking the trade, right? And it brings in some subjectivity potentially to your decision making. So, let me use this opportunity as well just to clarify another rule, because I've had some questions around this. Step one is always wait for the POI mitigation, right? I think we all understand that. You have to wait for this to happen. Then what we do is we look to, as soon as that POI mitigation occurs, we then look to see, has there already been a strong liquidation that we can use? If we look within this entire pullback at that point, right, once we get the mitigation, if we look left to the pullback, because this is the only area within the pullback that we care about, right, for the strong liquidation to occur. So if we look left within here and we don't see any strong liquidation, there's no fake break, then obviously we just wait for one to form here within the POI. If it forms, we take the trade. If it doesn't, then we don't, okay? But once we get that mitigation here and we do look within the pullback and we can see one, and then our question is, well, is this still relevant? How do we determine that? And the answer to that is whether or not the PBL is still active, whether or not it has done its job, okay? So again, once you get your mitigation, the strong liquidation can occur within the POI, it can occur before it, it just still needs to be active. So how do we determine that? And very similar to what you guys would have learned in the previous modules, it all comes down to the PBL, okay? So let's look at an invalid case first. For those of you who skipped ahead the lessons and you're not sure what PBL is, it stands for the point before the liquidation, okay? So when we get the strong liquidation occur, so the price pulls back, this low then breaks a high, so we have somewhat of a strong low. So we know that there's strong liquidity behind that low, so we draw on our liquidation line. When that line gets liquidated, when our strong low gets taken out, we can identify the PBL. That is the point before the liquidation. So if we liquidate a strong low, we identify the nearest supply zone that took out the low, okay? So the PBL is the nearest supply or demand zone that causes the strong liquidation, and it must not have been mitigated. Well, I'll get into that bit. So once we've identified the PBL, the supply that liquidated the low, okay, that would be this orange box. If price comes down, pulls back into that supply zone, pulls back into the PBL to mitigate it, and then the PBL holds, so price doesn't trade through it, the supply zone is respected, and then that supply zone leads to another move that breaks that low, right? It causes a lower low. So basically, that's when we say the PBL is held and the PBL has done its job because supply is held and it's caused a new low. If that happens, that means that we are no longer interested in this strong liquidation, okay? That is the mechanical way, a mechanical rule that you can use to solve that problem of asking, is the strong liquidation occurred still relevant for the move that we are trying to trade from this POI? Okay, because obviously step one is wait for the POI mitigation, so that will be here. At this very moment, we then look left and we ask ourselves, has there been a strong liquidation? Well, in this example, there has been, because this low broke that high, therefore it's a strong low. That low was then liquidated. So when we get the mitigation here and we look left, yes, there has been a strong liquidation, but then the second question is that strong liquidation still valid? Do we still have like that active strong liquidation for us? And the way we determine that is we go, right, where is the PBL? Here it is. This is the supply that liquidated that low. And is it still active? Well, no, because price pulled back into it. It filled up those orders, supply held, and it made a new low. That's how we determine if the PBL done its job, is we want to see it make a lower low with a candle closure, okay? Because especially if you're new, right, there's all these little intricate rules to try and keep track of, and it can be hard to remember. So the key with remembering things is trying to understand what the logic is behind them. The idea and the theory behind this, right, is why are we trying to identify strong liquidity, strong liquidations? Well, the idea is that if a low breaks a high, then we can, in theory, there should be more liquidity induced below that low, right, to induce more orders below that low. Why we want to see this in front of our POI or within our POI is because if we think big orders, the big guys, the big institutions are wanting to buy from here and get long, what do they need? They need opposing liquidity to enter the market with minimal slippage. In other words, if you're going to be entering with a ton of buy orders around this level, you need a lot of people selling to you at this level in order to get into the market at the price level that you want with minimal slippage. So that's why if we're looking to get long, we wait for that sell side liquidity to be induced below these strong lows, okay? Because that can increase the probability that this demand zone is going to hold, right? And we're going to see that movement. So that's why we wait for the fake break. We wait for strong liquidations to occur. But the idea around the PBL is that if the big guys are getting long and they're using that sell side liquidity, they should be able to take out supply and demand should be regaining control, okay? But if that supply holds and it does its job, well then this strong liquidation hasn't occurred, it hasn't worked, and we want to see a new one built, okay? So to keep it more simple, what you want to see is, again, step one. Always step one is you wait for the POI mitigation. At this very second your POI is mitigated and your alert goes off, what do we then ask? We ask, has there been a strong liquidation purely within the pullback, right? We're not looking at the leg, that's not relevant. We only look at pullback inducement, PBID, right? Has there been a fake break? Yes, it's the exact same example as here. There has been a fake break, right? This low broke that high, that is a strong low, and that has been liquidated. But once we get the mitigation and we look for that, what's the key difference here? Well, when we identify the PBL, which is the supply that liquidated this low, is it still active? Yes, price has not mitigated it at this point. When price is here, it has not mitigated it and it has not caused a new low. Therefore, that's a way we define that this liquidation is still relevant to this POI and this bullish idea. Okay? And the whole reason why is it's simply just to help us with, sometimes you'll get big volatile ranges, you'll get a strong liquidation up here, and then price comes all the way down, and then we get the retrace candle, that our entry. It's like, well, is this relevant? This is the mechanical solution that we have as a potential idea that you can use, okay? So this is invalid simply because when we get the mitigation, we can see it already held and made a new low, whereas this is valid because it's still active. So at that point, if we get triggered into the trade, we're just in the trade. We don't care what happens at that point, whether it gets stopped out or we hit target, whatever, okay? So it's up to you whether you want to use this rule or not. So what I'm going to do is I'm going to show you an example on the charts, but then I'm also going to show you an exception to the rule where I will ignore a PBL mitigation, okay? And I'm going to show you that. So again, it's up to you whether you want to use this rule or not. What I found in my testing is that this here doesn't seem to happen that often. I didn't really notice it. So I've actually struggled to find some real chart examples to show you of when this occurs. So it's not a very, very common thing, at least what I didn't very notice it. Maybe my brain was turned off to it. So you don't need to worry about it too much, but I think it's a good rule if some of you are kind of looking at liquidations very, very far away and wondering, should I be taking this trade? So let's look at some examples. So this trade here is not a high probability trade at all due to the medium time frame idea. That's not why I'm showing the example. I'm showing you this purely because it's only one I could find where there is what we're talking about with the PBL, okay? So, the basic idea of this is obviously the M15 structure has shifted bullish, and this is a M15 demand zone that led to a break of structure. The reason why I don't view this as a high probability trade idea is because I don't view this as a high probability POI. When you get these kind of straight pushes, like for me, this is one structural leg. This is basically just a pause in price action. It's got one straight push, it's got no leg inducement. Very often these sorts of POIs will fail. Not all the time, but a lot of the times, right? You want to see like a nice structural pullback like this. I basically view this as one leg, like a little pause in price action. Yeah, those POIs, when you kind of see them form like this, I just don't really have a lot of trust in them. But anyway, let's say we want to trade from this POI, right? We can do that if you so wish to choose so. So the M5 is going to be our execution time frame. So the first thing we do is we wait for our POI mitigation, okay? So we get our POI mitigation here. So then our next question is, has there been a strong liquidation? Well, technically we need to take the low to the left, okay? Because this was where that last fake break occurred. So it's a bit more of a unusual example, okay? Because, ideally we want to be focusing on the most recent price action, okay? But if we are very strict with kind of how we should be doing this, this is where that last fake break occurred here. So I'm just going to put this on as my M5 chalk. Okay, so once we got that fake break there, this is the extreme low of that movement, right? So then we can wait for it to get liquidated here. So once we get our POI mitigation, we can identify, was there strong liquidation? Yes, this is where it got liquidated. So then we can identify the PBL, right? We ask ourselves, is this relevant? Well, here is the supply that liquidated that low. Now, this obviously hasn't been mitigated. We now have our mitigation. So if you wanted to take this trade, I'm not advising that you do, but if you did, that's essentially how you would now place your order, okay? Because we have the POI mitigation, we have the liquidation, the PBL is still active, right? So this means that this liquidation is relevant, okay? And that's how you would set it. Now, whether you want to take, again, I'm going to keep reiterating, this is not a high probability trade at all. Like you can't even get one-to-one to the M15 high, et cetera, et cetera. But I'm just saying, if you wanted to take this entry model, it would be like that, okay? Next candle is an inside bar, so you would leave your order on if you wanted to take this trade. And then we push down. So obviously you would cancel the order the very second that low fails, and then you would wait for this new candle to finish printing, okay? So now we have a bit of a smaller candle, which obviously increases your risk reward and all that stuff, right? Depending on your stop loss buffer and how you want to manage the trade. It's not relevant to this lesson, but that's how you would then place your order, okay? If you still wanted to take this trade. And there we go. So you'd be in the trade. So this is an example where the PBL isn't really that relevant because it hasn't been mitigated. So you can just take the trade and you would be in. Now, as we can see in this example, the PBL ends up holding, and eventually, as we push down, we'd get stopped out here if you took that trade, okay? So that's fine. Now, let's forget about that trade for a second and whatever. Imagine you still want to trade from this POI and you like this trade idea. Well, the first entry has occurred and that would have been a loser, depending, you might still be in it if your stop loss is wide or whatever, but let's just assume it was a loser. Now, it's up to you whether or not you want to keep trading from this POI, okay? But if you do, you need to see a new strong liquidation occur in order to take a second entry if you follow the rules that I do. So do we have a new strong liquidation? Well, this low did what? When we took in that trade, another bullish change of character occurred, right? This low, there's a fractal pullback, and then price broke that high. So this means this is a strong low, right? That broke the high. So we now have another strong liquidation into our POI mitigation. So again, same thing. POI mitigation is step one. We're obviously within the POI. Step two, has there been a strong liquidation? Yes, we've just identified that, right? This low broke this high. That has now been liquidated. So then step three is, well, is this liquidation relevant? Is the PBL still active? Well, where is the supply that broke the low? It's here, right? This is the nearest supply that broke the low. Clearly, the PBL hasn't been mitigated and it hasn't made a new low. So that means this trade idea is active. So this is kind of a bit of a weird one. It's not quite like how I drew the example, right, where like kind of the PBL is far away. It's kind of all in one area, but it meets the same criteria. So the PBL hasn't done its job, but we do have a liquidation. We do have the POI mitigation. So that's an entry. Again, if you want to take this trade, that is how you would size it up. You would take it on that entry candle, okay? And that would be your trade. So next candle, what happens? Nothing happens. We get the inside bar. Okay, so we leave our order on. Again, another inside bar, we leave our order on. And then price breaks the low. Okay, so typically what you would do in that scenario is you would cancel your order, right, once that low breaks. And then because price is still within the POI, what would you then do? You would then set your order on top of this candle, right? That's normally what you would do. But hopefully you can now see that what has happened is price has pulled back into the PBL, the point before the liquidation. It has held, and now it's made a new low. So the PBL has done its job. Okay, so now actually, if you're following this rule and you're being strict with that rule, you are no longer interested in this trade idea. And if you wanted to keep trading from this POI, you would need to see new liquidity built and taken. You would need to see another fake break, right? Like a break at that high. This would then be your strong low. And then you want to see another liquidation and then you could take the entry. Okay, so that's a bit more of a subtle example, right? Because actually when you do get the initial liquidation, the PBL wasn't mitigated. Therefore, you could set your entry order above that liquidation candle. But then as it keeps going, what do you notice? Pull back into the PBL, it made a new low, candle closure below the low, right? Clear structural pullback into there, and then a clear new low. So again, if you want to follow that rule, trade idea would be over. Let's wait for new liquidity to be built. Does that happen? No. And now the POI has failed, so now the trade idea is over, okay? Because the POI must be respected in order to take this entry model. Okay, so I'm going to show you an exception to that rule in a second, but just to recap, keep an eye on this, right? If you notice there's a clear pullback, you kind of want to see a clear structural movement, a clear structural pullback, like at least a fractal pullback into it, and then a new fractal low, and then you get the mitigation. Then obviously that's not valid. You want to see a new liquidation, or this was a bit more of a subtle example where actually the entry was initially valid, but then whilst we're waiting to be tagged in, it then became invalid because we had that pullback into there and a movement down. Okay, so that's not quite an example of where like happens far away. I couldn't quite find one of that, but hopefully all the logic is still the same and it makes sense. Now I'm going to show you one exception to this rule. So the exception to the rule is basically when, well, let's just get into it and then I'll explain why. But it's basically when you have a very high probable scenario and you just want to get involved. So daily chart, we are clearly bullish. We pulled all the way back into the extreme. So this is obviously, we want to start thinking about catching that next bullish daily leg to the upside. Longs are going to start becoming high probability if our lower time frames start to confirm that. So we're within the daily demand. I haven't drawn on. We've come into this 4-hour extreme demand as well. Now we zoom into the more recent price action on the 4-hour chart. We're obviously bearish, right? We're moving to the downside. We last had a 4-hour break of structure here and we're quite overextended. So we know there's a pretty high chance that we're going to get at least a 4-hour pullback, right? We're coming to the extreme of the daily demand zone. The daily's bullish, so we're going to expect a bullish reaction. The 4-hour is bearish, but we can expect that 4-hour pullback to kick in. So we're starting to stack probabilities in our favor of getting that bullish movement. Now it's a bit more subtle, but if we zoom in, we can see that we have had a 4-hour bullish change of character. So that's another good sign that some bullish pressure is coming in. All right, we've had the fractal take of the low, fractal take of the high, bullish change of character. If we jump down to the M15, just going to play it forward a little bit. Okay, what do we get? We get a clear bullish shift in M15 structure. Okay, took the low, and then we took the highest point. Okay, and then we got a bullish boss. So now, what have we had? We've had that daily mitigation of the extreme demand when it's bullish at a strong low. The 4-hour charts come into that level and hit the refined 4-hour demand that I haven't drawn on within there. We've had a 4-hour bullish change of character. The M15 has now clearly shifted bullish. We've had a nice big liquidation of these lows as well, okay? Just some extra confluence. Nice big V-shaped reaction. So this is actually the type of example where this is very high probability for me, and I would actually consider setting a risk entry on my medium time frame POI. When I see this sort of price action, I'm just looking for an excuse to get involved. I want to get in long, and I would consider setting here a risk entry here. Of course, we also have the extreme that we can keep an eye on. But yeah, start of that new pullback, strong momentum, prices rarely in these scenarios pulls all the way back down to here. So I'd be very happy to set a risk entry. But let's say we're looking at the LC2A on the M5, okay? So what do we need to wait for? We need to wait for our POI mitigation, okay? So if you're doing this live market, you just set your alert and you would wait for your POI to get mitigated. So now your mitigation happens, alert goes off, okay? That's step one. Step two, has a strong liquidation already occurred within the pullback, right? But only looking at strong lows within the pullback. This low didn't break any highs, okay? This low, that's all one down movement. So that didn't break any highs, so that's not a strong liquidation. This low didn't break any strong highs. Now this one is a bit more subtle, and this is where you have to be really careful and not rushing when you're backtesting. It's almost a little bit easier in a live market to spot entries because you see price action form and it's easy to see it and keep track of it. But people can very easily miss this when you're backtesting, okay? So what has happened here, I'm going to bring it back so we can see, is at this moment, the fractal high is here, okay? We can see that, right? That's that last fractal pullback. So that's the fractal high. If we play forward the next candle, nothing happens. Then the next candle, it takes the high and then it takes the low, okay? So again, it'll be a little bit easier to see when you're trading live, but the way this forms, you can check on a lower time frame if you don't believe me. Price moves up. So the very, very second that price breaks that high and causes that bullish change of character, whereas the fractal low, it's down here. Okay, so we have an up movement, causes a bullish chalk. This then becomes a strong low. This can potentially be our fake break to the upside, and then price comes down and liquidates that low, okay? So now what do we have? Now we have a strong liquidation on the M5, okay? Now, at this point, you now have a valid PBL, right? This is the supply that caused the break of this low. Now we play price forward one more candle. Price pulls back into that supply, into that PBL, and fills up some of the orders. And now what happens? Now price goes to the downside. So if you're coming to a chart at this point, you go, right, step one, POI mitigation, yes, tick. Step two, has there been a strong liquidation? Yes, it was a bit more subtle, but we can see, right? Break of the high, that was a strong low, that low gets liquidated. Okay, step two, we do have a strong liquidation. Step three, is that strong liquidation still valid and relevant for our bullish idea? Well, if you are 100% strict with the PBL rule, no, Because when that PBL was created, what happened with this next candle at 1:05 p.m., price pulled back into that supply, filled up those orders, and then technically made a new low, okay? So there's two reasons as to why you can make an exception here and ignore this rule. The first one, and probably the more important one, as always, is because of the medium time frame idea and the medium time frame POI. For the reasons I explained, looking at the daily chart, again, I'm going to go over it. This is very, very, very high probability for me. Bullish daily chart, we pulled that down into the daily extreme, big risk reward on our side. Obviously, I'm not going to be targeting that move, but this is the area in which we can start getting aggressive in longs. It makes sense. 4-hour chart is starting to back that up. It's still bearish, so long as a counter 4-hour chart. But look how overextended we are after the boss. We're expecting the pullback. We had a bullish 4-hour change of character. The M15 is even better, right? Nice big strong liquidation, which is another sign that potentially, that bullish pressure is going to start coming in. We then get that confirmed with a nice big strong bullish move, giving us our bullish breaker structure. We have a clear POI, right? A lot of momentum came in. Very often when you get that initial trend change, price won't always pull back to the extreme. This is the exact type of POI, right? Nice sweep where I would consider even setting a risk entry. Okay, so the medium time frame idea is very, very high probability, and that's why I'm just looking for an excuse to get involved. And this is the most important thing about the entire strategy is your medium time frame idea and your medium time frame POI selection. So I already know I want to get involved anyway, so I'm almost willing to ignore the PBL in this scenario. But the second reason that helps me to ignore the PBL in this scenario is how the mitigation formed, okay? Because really, it's like, if we just look at structure for a minute, and I delete these drawings, it's just kind of one fractal leg down, right? All of these candles break the previous candle's low. Really, it's just one movement down to the downside on the M5, okay? What would be different is if we came down, we had a clear structural pullback into the PBL, right? Mitigated those orders, and then had a clear structural break to the downside, right? Like this is a straight movement down. That's a structural pullback into this supply zone. And then we get like another leg down. That's kind of what I mean. Whereas this is kind of just one movement. It's just efficient price action. So you have to really ask yourself, do you care about it as much? Like in this one, right? Again, that's a little bit more subtle, but you still have that fractal pullback and then you have the movement down. Whereas this, it's kind of just one leg. So when I see kind of just efficient corrective price action like that, rather than a down movement, a clear pullback on a down movement, and combined with the fact, and this is the more important fact, of how high probable the scenario is, that's where I'm willing to ignore that, and I just want to get involved. And at this point, we've had the mitigation, we had the strong liquidation. I'm not going to redraw it because you guys can see it, and I would set my order on here, and there we go, right? Okay, inside bar, nothing happens, leave the order on. Okay, that low breaks, so we cancel our order straight away. Wait for this candle to close. This POI is still being respected, therefore the trade idea is still valid. Reset the order, okay? And then you're tagged into the position, and then what will be, will be. So a bit of a longer lesson on sort of a quick common mistake, but it's a current idea that we have, a mechanical idea for really trying to solve this problem, because I can't really find a perfect example of it, but sometimes the liquidation is very, very far away. I think it happens on GU a lot more because the price action ranges are a lot more volatile and bigger. But this is our solution to that. So some of you may still want to use some discretion, and if you see that this is miles away, you're probably just going to ignore it anyway, and you might want to see something more relevant. But whilst you're testing, this is a good mechanical rule that you can use. But I've also shown you where you may want to use a little bit of discretion and ignore it, because that's personally what I'm going to do. I'm going to use that little bit of discretion and go, do you know what? The medium time frame idea and the medium time frame POI is way more important to me. The lower time frame entry model is simply a timing mechanism for those ideas. So if we're right in this area, tiny POI was being super accurate anyway, like I just want to look to get involved, right? For me, I'm going to ignore that. So hopefully that makes sense, and hopefully it's a nice solution if some of you are questioning whether or not a liquidation is still relevant.